Good morning and welcome. This is part of the Audit, Control, Governance, Risk and Compliance Series 1. As part of this series, we will be covering 11 areas. The details are as shown. Good morning. As part of this series on audit, control, governance, risk and compliance, we will be touch basing on the aspect of governance in an organization. Governance plays a critical role in ensuring the success, stability, and sustainability of an organization. It provides the framework for decision making, accountability, and operational integrity, which are essential for achieving organization's goal. Good governance ensures transparency, enhances efficiency, and foster stakeholder trust, while poor governance can lead to inefficiency, legal issues, and reputational damage. This lecture series explores the importance of governance in an organization, focusing on the benefits of good governance and the risk associated with poor governance. Governance in an organization refers to the system, the process, and the policies that guides its operation and decision making. It involves setting objectives, monitoring performances, and ensuring compliance with legal and ethical standards. Governance structure typically includes boards of directors, executive leadership team, compliance officers, and others. They oversee strategic planning and risk management. Effective governance foster accountability, fairness, and responsibility within an organization. To understand governance, we have to understand a lack of it. What is that we lose when we don't have governance, or our governance is weak, or governance is completely missing? To appreciate it, let us go through some case studies. Mostly all well known, some might be known to a particular region or a country, but our learning is for everyone to understand and engage with. The first one is from Wells Fargo. This is a case where fake accounts were created around 2016. That's the time period when this scandal came out. In this, aggressive sales target led to employee to open up about 3.5 million unauthorized accounts. What was the impact? $3 billion in fine US. The CEO had to resign, and more important, very high reputational damage. Something which took years for Wells Fargo to build in, and it will take years to build it back. Conclusion: unethical culture and poor oversight can drive systematic misconduct. Case 2. This is related to the Deutsche Bank money laundering and sanction violation. Specifically, this has come up in Germany. Apparently, happened over multiple years. So what was the weakness in the governance? Weak compliance allowed laundering of billions through mirror trading and dealing with sanctioned entities. What was the impact? $10 billion globally, and an increased scrutiny from regulators. Understand the impact here. Once the regulator is suspicious, they would come and review it regularly. Reviewing is a lot of effort, a lot of data has to be provided, a lot of controls has to be built, which includes cost, resources, time and effort. Conclusion: A poor risk governance can expose banks to legal and reputational ruins. Case 3, the 1MDB scandal involving an organization specifically in and around Malaysia and US between 2015-2020. In this case, the weak governance was there was a lack of due diligence and internal checks which enabled bribery and misappropriation of about $4.5 billion. The impact $2.9 billion settlement with US Department of Justice and damage to Goldman's global image. Again, an image which took years to build, decades to build, in fact, and it will take years to build it back. That's a huge cost. Conclusion: lax oversight of deals and third party leads to legal and reputational risk. The next one is from India. It's around 2018, famously known as the PNB Nirav Modi fraud case. In this case, there was failure to reconcile the SWIFT transaction with the core banking, allowing about 14,000 crore of fraud, 14,000 crores INR, Indian rupees. Impact: loss, stock crash, and loss of trust. Conclusion: IT governance and reconciliation controls are vital in fraud prevention. When missed, the loss is unimaginable. The next is in 2008, the Anglo-Irish Bank collapse. In this case, there were reckless lending to real estate insiders and lack of transparency. It cost the taxpayer about $29 billion. In addition, the bank had to go through a lot of restructuring. Conclusion: chronism and weak board oversight can trigger systematic collapse. 1995 UK, the Baring Bank collapse. In this case, a single trader conceded massive losses due to lack of separation of duty. The loss: 827 million, and the bank collapsed. In this specific case, there was a failure of internal control, and the result, it brought a historic bank down. As we move forward with such cases, think through your experience till now. Has this already occurred in your presence, or is it happening now as you are reading this, or do you foresee something like this happening, and what are you going to do about it? The next case is again from India, 2018. This is a case of conflict of interest, specifically between bank by the name ICICI and a group called as Videocon. In this, the CEO approved loan to this group, and internally the CEO had ties with the family and the businesses. So there was a big conflict of interest. The repercussion, the impact: the CEO had to resign, reputational damage not just for the CEO but for the organization per se, and damage to reputation, as mentioned earlier, takes years or decades to build, and sometimes it never comes back. In addition to it, regulatory probes, which has its own downsides and cost. Conclusion: conflict of interest without disclosure destroys the stakeholder trust, which happened in this case. The next one is 2018. It's a money laundering scandal. About $230 billion laundered via the Estonia branch, or rather one of the branches, and this was because of the poor anti-money laundering controls. The impact: The executive had to resign, share collapsed, and there are subsequent huge fine and regulatory reviews. Conclusion: governance lapse in overseas branches can have global consequences. Now, in this case, think through. You are a global bank or you are a bank with global footprints. You might have a very strong governance centrally or in key locations, but maybe those governance are not in place, or at least in theory in place, but in practice not so. So a governance issue in one small branch or one section of your business, if you believe that doesn't affect much, this is a classic case where the activity of shady nature happened somewhere else in the section of the branch or a location, but it affected the whole bank. You, as an auditor, as a risk manager, as a manager or a management group, need to be aware of ensuring governance is just not at the center but spread across evenly, because an impact there will impact you. Need to be mindful of it. The next one is the 2021 scandal. There were inadequate risk oversight and concentration of exposure. About $5.5 billion were lost and triggered a major shakeup in leadership. The conclusion here is risk governance must account for counterparty exposure and complex products. This is where the risk managers should be alert. You would be dealing with cases or conditions where you have to deal with counterparties, and an exposure or a weakness on that side might impact you, as in this case. And many a times with complex products, there might be a weakness in one section of the product which exposes the other which touches those. Hence, need to be alert of it. The last case for this conversation is 2014. A bank collapsed in Portugal. This happened because of concealed losses and insider loan across a complex group structure. A $4.9 billion bailout, plus the bank broke up, again caused due to lack of transparency and complexity, leading to a systematic risk. Do note, the details of these are publicly available. If you want to go deeper into each case, it can be done. Do review them, and that experience is something that will help when you are managing your area and your space. Now, with the perspective of the case studies on the impact of having a poor governance or missing governance, let's look at the bullets points to summarize. From a financial mismanagement and fraud perspective, poor governance can lead to financial mismanagement, resulting in losses, inefficiencies, and even bankruptcy. Without proper oversight, unethical practices such as fraud and embezzlement can thrive, undermining an organization's financial stability. From a legal and regulatory consequences perspective, organizations with weak governance structure are most likely to violate laws and regulations, leading to legal penalties, fine, and reputational damage. Non-compliance with industry standards can also result in operational restriction and loss of license. A lack of transparency and accountability erodes stakeholder trust. Investor may withdraw funding, customers may lose confidence, and employee may become disengaged, all of which can negatively impact an organization's performance. Without a robust governance framework, decision making can become arbitrary and misaligned with the organization's goal. Ineffective leadership, conflict of interest, and lack of oversight can lead to poor strategic choices, causing long term damage. Reputation is a valuable asset for any organization, and poor governance can quickly tarnish it. Scandals, unethical behavior, and lack of corporate responsibility can lead to negative media attention and public distrust, impacting its brand value. A brand value which the organization might have taken decades and in few cases near a century. Building it back is not going to be easy in any form and shape. In fact, it could be double the effort and more. And it could also be that in spite of all the efforts, we never able to get back the reputation that we had earlier. From an organization inefficiency and low employee moral perspective, organizations with weak governance structure often suffer from inefficiencies, internal conflict, and lack of clear direction. This results in decreased productivity, lower employee morale, and difficulty in attracting and retaining talents. Think through on this. Retaining talent is a challenge in any time. With poor governance, it's not going to be easy because once that comes in, the word spreads, and the best of the talents would not like to associate themselves with such organization with poor governance. Let's now take this opportunity to review what good governance looks like. We'll take case studies so it becomes easier for us to relate or aspire. The first case is post 2008 Bank of Canada, demonstrating how financial stability framework works, should work. In this case, proactive macroprudential oversight and coordination with fiscal authority was one of the key strengths of this organization. The impact: Canada was one of the few G7 countries that avoided a major banking crisis of 2008. So the governance was in place. So when the tsunami struck, it helped, the framework helped the country as a whole with lesser damage as compared to the rest of the world. In conclusion, strong governance and regulatory coordination ensured resiliency of their setup. Case 2, that's from India, Reserve Bank of India's prompt corrective action, the PCA framework. In this, there were clear threshold for capital, asset quality, and profitability to restrict weak banks. What was the impact? Early intervention helped prevent several cooperative and PSU banks' failures. In conclusion, structured governance tools promote accountability and preemptive risk mitigation. The next case in point is from Singapore, wherein the governance helped promoting innovation with risk oversight, helping Singapore as a whole to become a global fintech hub with minimal systematic disruption. Conclusion: forward looking governance enable both innovation and stability. The next case is from UK. This is post 2008, in specific Bank of England's ring fencing of retail banks, wherein it was mandated for separation of retail investment banking activities. This reduced the risk from trading operation to consumer deposits. Conclusion: structural reforms improve the soundness of banking system. The next case is from US. This is from JP Morgan, specifically about the risk management during the 2008 crisis. In this case, strong risk culture and diversification helped the bank to survive, and in this case even acquired failing companies like Burrs and Stearns and few others. In conclusion, prudent governance and risk planning can be a competitive advantage in crisis. I advise risk managers and management to think through on this case how having an effective governance helps the organization to be more competitive and take advantage of the risk. Very few are able to do it as effective as it was done by JP. The next is from 2010 and from Australia, wherein they launched a robust ethics and whistleblower framework. It improved their internal transparency and reduced misconduct risk. In conclusion, ethical governance promotes trust and long-term sustainability. In this case, a strong, clean risk management framework promoted trust. And as we discussed earlier, the value of trust is something that can only be known when we lose it in most of the cases. Next is from India. It is about the digital transformation governance framework that one of the banks, which is the State Bank of India, had put in place. It included strong governance around digital innovation, the impact, broader financial inclusion, bringing in operational efficiency, and of course customer satisfaction. Conclusion, strategic governance of technology modernizes legacy banking effectively. The next case is wherein early adoption of ESG governance in investment and leading practices helped the bank with its reputation and attracted global green capital. Conclusion, integrating sustainability into governance drives long-term value. This is a case of 1994, wherein autonomous central bank with inflation targeting framework was put in place, helped anchor inflation expectation and enhanced investor confidence, something that has been a landmark. Many banks have factored this within their governance. In conclusion, the results of this was institutional independence strengthened monetary and economic stability. The last case for this conversation is on the UO Bank. In this case, the good governance was related to the cybersecurity governance and resilience program, board-led cybersecurity risk governance, and threat monitoring helped the bank in building a very high customer trust, resulting in zero major breaches reported during raising threats. While other banks struggled, this program helped the bank in its reputation. Conclusion, proactive governance of cyber risk is critical in digital banking era. With the benefit of knowing the positive effect of good governance and the examples that I shared earlier, let us now summarize the benefits of good governance. Good governance ensures that decision-making processes are structured, well-informed, and transparent. Organizations with strong governance framework rely on data-driven insights, ethical consideration, and stakeholder input to make sound decisions. This leads to better strategic planning and resource allocation. Transparency in governance allows stakeholders, including employee, investors, and customers, to have a clear understanding of an organization's operations. Accountability ensures that leaders are answerable for their action, reducing the likelihood of fraud and corruption. Regular audits, ethical code, and reporting mechanism contribute to a culture of integrity. Good governance includes robust risk management practices that identify, assess, and mitigate potential threat to an organization. Whether financial, operational, or reputational risk, proactive governance framework help organization adapt to changing environments and avoid crisis. Organizations with strong governance practice earn the trust of investors, customers, employees, and regulators. A good reputation attracts investments, enhances customer loyalty, and strengthens partnership, ultimately leading to long term success. Compliance with law, regulation, and ethical standards is a cornerstone of good governance. It ensures that an organization operates within legal boundaries, reducing the risk of fines, lawsuits, and operational disruptions. Organizations that prioritizes compliance are better positioned to navigate complex regulatory landscape. Good governance promotes long-term strategic planning and sustainability. Organizations that incorporate ethical business practices, corporate social responsibilities, and environmental considerations are more resilient and adaptable to future challenges. In conclusion, governance is the backbone of a successful organization, ensuring accountability, transparency, and long term sustainability. Good governance fosters strong decision making, risk management, and stakeholder trust, while poor governance exposes an organization to financial, legal, and reputational risk. Organizations must prioritize governance framework that align with their mission and values to achieve sustainable growth and resiliency in an ever changing business environment. We have now covered four sections of this series: the introduction, the history of banking, regulators in banking, and now the governance.